Welcome back to the deep dive. If you checked the charts this morning, you definitely saw a lot of red.
A lot of red. The market delivered some immediate pain, retreating hard from those recent highs.
It did. But what we found in the source material for today's deep dive is this profound and really fascinating disconnect happening.
It's more than just a dip. We are, I think, officially in what you'd call a divergence event.
A divergence event, okay.
Yeah, the short-term price, which is, driven by tactical sellers, is pulling back. But at the same time, the long-term foundational infrastructure of this whole asset class is being, cemented into global systems.
Okay, let's unpack this, because that decoupling is the central challenge of our briefing today. We're tracking a market with two dramatically different time horizons.
That's why our thesis is built around infrastructure permanence amidst price discovery.
Right. The market has this dual view. It's like one eye is on yesterday's gains, and the other is just fixed on the regulatory and institutional landscape of tomorrow.
Exactly. One segment of the market looks backward, they see the huge run-up we had, and they're taking profits. That's fueling the sell pressure.
And the other segment?
The builders, the regulators, they're looking forward. They're looking at regulatory normalization, at state-level integration.
So our mission today is to cut through that noise. We need to explore the specific data that explains why these tactical institutional sellers are heading for the exits right now.
And then immediately pivot.
Yes, and immediately pivot to understand the truly permanent structural rails that were laid down in the exact same 24-hour period. So let's start with the pain, the tactical retreat.
Yeah, we have to. We have to confront the immediate liquidity situation because it's a major technical factor. Bitcoin failed to break that really crucial $94,000 threshold.
And now it's struggling around, what, 90,600?
Around 90,643, yeah.
That drop raises a critical question for you then. What exactly caused this immediate sell-side pressure? Because it didn't feel like just retail fear.
No, it wasn't. The answer is found squarely in the flow data, and honestly, it's alarming.
Yeah.
The U.S. spot Bitcoin ETF complex recorded a net outflow of $486 million yesterday, January 7th.
Wow. $486 million. That's the largest single-day net outflow we've seen this year, right?
It is. It's a massive, sharp reversal.
That number is huge. But we have to know who is selling. Is this just the usual background noise from Grayscale, or is this new, high-quality institutional money hitting the exit?
It's definitely the latter. And that's what signals a tactical retreat. If you look at the issuer breakdown, Fidelity's FBTC led the weakness.
Fidelity.
Yes, a massive negative flow of minus $248 million.
Okay, so what does that tell you?
It strongly suggests coordinated rebalancing by RIAs, registered investment advisors and other advised accounts. These are clients who hit their initial targets around that $95,000 mark and just aggressively took capital off the table.
But wait, BlackRock has been the bellwether, right? They've been the primary accumulator in this whole space, almost always net positive. If they're selling too, doesn't that sort of undermine the hot money thesis?
Well, that's where the risk-off sentiment becomes, frankly, undeniable. BlackRock's IBIT also saw negative flows.
How much?
Minus $130 million. And when your primary accumulator like IBIT turns negative, it confirms this is a broad institutional sentiment shift. It's not just an isolated Fidelity thing.
And Grayscale.
Grayscale's GBTC, while still contributing, was more like constant background noise, only minus $83 million. They were not the main catalyst for this.
So the takeaway is that the capital that rushed in on that run to 94K was indeed hot money. Tactical allocators who just unwound their positions the second the asset failed to breach 95,000.
Exactly. This isn't the sticky, long-term sovereign wealth or insurance money. Not yet.
And the technical implication for everyone watching the charts.
It's pretty clear. Until these ETF flows stabilize, the price is just going to lack that passive bid support it needs. The market now faces a real risk of a deeper drawdown to the critical $88,000 support level.
88,000. Why is that number so important?
It aligns with a few key indicators, including the lower boundary of the Ichimoku cloud on the daily chart. That 88K mark is really the line in the sand for keeping this medium-term bullish trend alive.
Okay, so we have the short-term pain mapped out. Now we pivot, because this is the crucial part of the briefing. Despite all this technical pressure, the structural connections, the pipes between the digital and traditional economies, they were significantly fortified in the exact same 24 hours.
This is where you see the real long-term narrative unfolding. And there were two massive acts of permanence.
Let's start with the first one. This feels like corporate validation on a global scale.
It really is. We were talking about the decision from MSCI Inc.
Which runs many of the indices that global passive funds are forced to track.
Exactly. And the detail here is profound. MSCI announced it would not exclude what they call digital asset treasury companies, or daddy tokos.
So companies like MicroStrategy.
Precisely. They won't be excluded from their global equity indices. And this decision averted what could have been a systemic market event.
I mean, it was a crisis averted, potentially worth, what, $8 to $10 billion in forced selling?
At least. Had MSCI reclassified MicroStrategy as, say, a pure financial investment vehicle, all those passive index funds tracking their benchmarks would have been forced to dump their MSTR shares.
But they didn't.
They didn't. And by choosing not to, MSCI essentially validated the Bitcoin treasury model as a legitimate corporate strategy. That's a huge structural victory.
But there was a catch, right? A little bit of nuance. It wasn't a total blank check for everything MicroStrategy does.
Correct. They put in a restrictive caveat. You could call it an index penalty box. MSCI said they won't increase MSTR's index waiting for any new shares issued through their ATM equity offerings.
So that limits that feedback loop where the stock rises, forcing funds to buy more, but it keeps them in the index.
It keeps them in. It removes that catastrophic forced seller risk.
And the market reaction confirms it. MSTR shares jumped 6 or 7%, totally decoupling from the falling spot Bitcoin price.
It confirms investors are pricing in the removal of that regulatory overhang.
So that's corporate standard validation. Check. What's the second act of permanence?
This one is arguably even more profound. State sovereignty and monetary innovation. We have to talk about the Wyoming Protocol.
The State of Wyoming. They officially launched the Frontier Stable Token, or FRNT.
And this isn't just another stablecoin. This is the first sovereign state-issued cryptocurrency in the United States. It's a direct challenge to the federal monopoly on digital dollar issuance.
And it's issued by a state agency, the Wyoming Stable Token Commission.
Yes, and it's fully reserved one-to-one with U.S. dollars and short-duration T-bills. And for maximum trust, the reserves are being managed by Franklin Templeton.
A legacy asset manager with, what, $1.6 trillion in assets?
That's the one. So you have serious institutional plumbing backing a state-level cryptocurrency.
Technologically, they were smart about it, too. It's not isolated.
Yeah.
Issued natively on Solana and then immediately bridged to Ethereum Avalanche.
Designed to be a liquid primitive from day one. And here is the strategic masterstroke, which really speaks to true permanence.
What's that?
The interest. The interest generated from the reserves on those treasuries will be used to fund public schools and state services in Wyoming.
So by doing that, the state creates a regulatory fait accompli, an accomplished fact that's really hard to reverse.
They are leveraging the 10th Amendment, which reserves powers to the states, to insulate the stablecoin market.
I mean, think about that for a second. A potential federal ban on stablecoins now becomes infinitely more complicated. Because the feds would be banning a legitimate, yield-generating financial instrument issued by a sovereign state government with the yield directly funding kids' education. That is a regulatory shield.
It fundamentally shifts the dynamic from permission to acceptance.
Okay, so that's integration at the highest level. Global indices to state treasuries. Now, let's talk utility and truth. These aren't just financial maneuvers. These are changes to how we process information and how we send payments.
We're moving beyond just price here and talking about real-world application. That's the ultimate marker of permanence.
First, let's look at the financialization of truth. This partnership between Dow Jones,
the parent company of the Wall Street Journal.
Right, and the decentralized prediction market platform, Polymarket. This is fascinating.
It is an incredibly interesting shift in what we consider credible data. Dow Jones announced they're going to embed real-time Polymarket data, they're calling them market-implied probabilities, directly into their articles.
So right alongside traditional analyst reporting.
Right alongside it. So the Wall Street Journal will now report that, based on capital deployed on the blockchain, the market assigns a 65% probability of a certain event happening instead of just relying on analyst consensus or polling.
That's the mainstream acceptance of skin-in-the-game forecasting.
Exactly. People are literally putting their money where their mouth is on the blockchain, and one of the world's most prestigious financial publishers is now using that network as a core data source. It elevates the blockchain to a source of financial intelligence, a truth machine, essentially.
And the utility doesn't start with data. Look at the creator economy. with the video platform Rumble launching a non-custodial crypto wallet.
In partnership with Tether, this is a huge demonstration of the PayFi thesis, payment finance.
And the wallet supports USDT, Bitcoin, and Tether Gold. But the crucial part is that it's non-custodial.
That is the major distinction. Rumble does not hold the user keys or the assets.
Which means they're building a genuinely censorship-resistant payment rail for creators. If a creator gets deplatformed by, say, PayPal or Visa,
they can still monetize. They can still get paid through non-custodial tipping directly in the Rumble wallet. It completely bypasses those central banking checkpoints.
It creates a resilient, uncancelable monetization layer. It institutionalizes value for content without needing permission.
If you connect all these structural fortifications, MSCI, Wyoming, Dow Jones, Rumble, they all happened in the same 24 hours that the market was in a tactical panic.
That synthesis is the core takeaway. The structural floor is getting thicker every single day, even as the market flushes out leverage.
And we should briefly touch on the regulatory and ecosystem intelligence that also signaled long-term stability in that same window.
Right. There was that subtle but powerful shift at the SEC.
Absolutely. SEC Commissioner Carolyn Crenshaw, who was the sole dissenter on the Bitcoin ETF vote and a known crypto skeptic, she officially departed the agency.
So a key obstructionist voice is gone.
It's gone. And at the same time, the SEC's Crypto Assets Task Force announced a listening tour. This signals a pivot championed by Commissioner Hester Pierce away from regulation by enforcement and more towards regulation by dialogue.
Which is a much healthier environment for innovation.
Much healthier. And then bridging the gap in Europe, we saw StoneX Group secure the MiCA license. That's the EU's big crypto regulation.
So now they can offer regulated crypto services across the entire European Union. That's going to attract traditional macro funds looking for that clarity.
For sure. And finally, you have to look at the mining sector, which is showing its own structural divergence. It's moving beyond just mining Bitcoin.
Yeah, we saw two big updates showing different paths. First, HIVE reported strong December production, 306 BTC.
Which is a 197% increase year over year. Their whole focus is on extreme efficiency. They're at 17.5 joules per terahash and expanding their hydro-powered capacity.
So that's the classic efficiency and scale play.
Right. But on the other side, you have Hut 8. They produce less, only 89 BTC, but they're making a very different strategic bet. They're transitioning into a diversified compute-as-a-service company.
So they're getting into AI.
Exactly.
Yeah.
The real story there is their massive $7 billion lease with FluidStack for AI compute. They are actively reducing their correlation to the spot Bitcoin price by becoming a crucial AI infrastructure provider.
So what does this all mean for you as you're trying to navigate this volatility? We've really confirmed the dichotomy here. The market is tactically bearish.
Driven by that $500 million ETF exit and the failure at 95K.
But it is powerfully, structurally bullish. Confirmed by MSCI, by Wyoming, by Dow Jones.
The current analysis suggests the market needs to flush that leverage out. So expect continued volatility and keep a close eye on that $88,000 support level.
So this dip shouldn't be viewed as a fundamental trend reversal.
Not at all. It's a necessary liquidity event within a long-term secular uptrend. The infrastructure is becoming permanent, even if the price path is, a bit rocky.
That structural floor is just getting thicker, deeper, and more integrated every single day.
It is. And if we connect this all back to that Dow Jones and Polymarket news, it raises a really important question for you to think about after this. The system is now integrating market-implied probabilities from decentralized platforms as a source of financial truth. So if these prestigious centralized news organizations are now relying on real-time, skin-in-the-game data from the blockchain, validating it as a superior mechanism for information discovery, what is the future role of the traditional financial analyst or the pundit?
That is a big question.
It is. If the decentralized crowd operating with real capital at risk is deemed a better curator of financial truth than the expert you see on TV, how does that fundamentally shift where we look for epistemological authority? That is the question this divergence leaves us with.